Hey, everybody. This is Joe McCall, the Real Estate Investing Mastery Podcast. Glad you're here. This is part 2 of an exciting series. Well, exciting in a certain way. Some of you guys, it's painful. And we're on a series right now called Deals Gone Bad. And I posted this just the other day. I just had this harebrained idea. Let's do this podcast series called Deals Gone Bad. And I posted it on Facebooks and I said, hey, is anybody interested in sharing their bad story of deals gone bad? And a ton of people said, yeah, I'd love to share. A lot of people said this is a great idea. And so I thought let's do this. Let's just interview people who have had bad deals. And guess what? We've all had bad deals, right? And if you haven't had a bad deal yet, you've not been in the business long enough. So sometimes somebody said once, smart people learn from their mistakes. Wise people learn from the mistakes of others. And so Vamsi is the special guest that I have today coming from Florida on today's podcast. And he's going to be talking about some deals that he had that turned bad. But he's learned a lot from them. And here's the great thing about this, guys. Many times we learn more from our mistakes and bad deals than we learn from the good deals, right? And if you take advice from somebody who's only been doing deals from the last 5 years, you got to be careful. Take a little bit of grain of salt with the advice that you get, because like in the last 5, 7, 8 years, it's been almost not impossible, but it's been hard to lose money because the market has been so strong. So I love hearing advice from people that have rebounded, people that have hit the bottom and then bounced back up, people that have made a bad mistake or bought a bad deal, but bounced back and recovered from it, didn't quit, didn't give up. And so I feel like you guys, we're all going to learn more in some ways from the deals that gone bad than the deals that gone good. There's so many people out there sharing the big checks and the Lambos and the mansions and all of the success and the money and and that's awesome. It's exciting to talk about. And I'm glad people do talk about that, but nobody's talking about the bad deals. So in this series, we're going to be talking about deals gone bad. And I'm doing as we go through this, I'm recording these podcasts. They're being released at the Real Estate Investing Mastery Podcast. If you've not subscribed to the podcast, what's going on? I release 2 or 3 episodes a week at the Real Estate Investing Mastery Podcast. So if you're watching this on the YouTubes, go to Apple Podcasts or Spotify or Google Podcasts or TuneIn Radio, Stitcher, wherever you listen to podcasts. And download the podcast, subscribe to it, leave us a review. Let me know that you like the show, what you like about it. Let me know if you like this series here. I'd really appreciate it. So YouTube, I got a YouTube channel. Do you guys subscribe to the YouTube channel yet? Go to YouTube, subscribe. Just do a search for Joe McCall. We release about 2 or 3 episodes, videos a week. And this podcast right now, as I'm recording it, is being broadcast live on YouTube and Facebook. So if you're watching this in YouTube and Facebook, hello, what's going on? Hey, and we can see your comments live. So don't say anything mean. Type nice stuff in the comments. Say hello, and I'd love to give you a shout out and say hi. And if you have questions, let us know. Like Mark Davis, what's going on, brother? Good stuff, he says. So if you've got comments like that, tell us hello. Tell us where you're from here in the podcast on YouTube or Facebook. Type in some comments down below. All right, one more final announcement thing here before we bring our friend Vamsi on. I've been keeping notes from these podcasts. I've been trying to keep notes in a mind map, and then my assistant comes afterwards and listens to the recording and adds to my notes, because it's hard for me to take notes while I'm talking to my guests. So if you want the mind map or the notes from these podcast series, text the word bad to 313131. Again, text the word bad. I don't know why I picked that word, to 313131, or you can go to joemccall.com/bad, and we will forward you a link to view the mind map and the notes. I'm thinking about turning this podcast series into a book or something like that, because I think it'll be really helpful for you all to see lessons learned from things like this. Okay. So again, text the word bad to 313131 to get the notes from all of these podcast series. I already have like 20 or 25 of these lined up. So I'm excited about this. Or go to joemccall.com/bad. Okay. All right. Let's bring Vamsi on. Vamsi from Florida. How are you, sir?
I'm good, Joe. How are you?
Nice. Good. Very good. Thanks for being on the show.
Thanks for
And
having me.
I appreciate you being on. And you were one of the first that raised their hands in my Facebook feed and said, yeah, I'll talk about my deals. And I appreciate that. I really do. You're in Florida right now, right?
Right. Yeah.
And how long have you been doing real estate?
I started with real estate in 2017 December. That was my very first investment into real estate.
Okay, 2017 in December. And do you do real estate full time, or do you have a job? Or
I'm actually an IT consultant, and I was doing it part time. But right now I'm out of a project, so I'm doing it full time. If I find a project, I might take it again part time. Try to go back and forth between full time and part time. But my goal is to be in it full time.
nice, good. What got you interested in real estate?
So what happened was, okay, it's a funny story. So I'm a consultant and I make an hourly wage. And as a consultant, you know that there are times where you don't have a project and you have no income. So what I did was I said, okay, let me just make as much money as I can in the next 6 years, have a sizable amount of saving, and then take up a full-time job, and then just have fun, stay local, be with my kid and my wife. But after that, I bought a Tesla, and I realized that my initial goal was make up 1.5 million, pay 30% taxes, have that 1 million cushion, and then I can live the rest of my life happily. That one Tesla took me down by $100,000, and that's when I realized, that's a very bad game plan. And that's when I started educating myself, read Rich Dad Poor Dad, which is really one of the very first books which got me excited about investing into real estate. And then I joined his what do you say? I subscribed to his channel. I learned a lot about real estate, and then I got very interested. And then I joined a lot of other podcasts, which sparked my interest in real estate.
Nice. And who's your favorite podcast?
So my favorite podcast obviously is from Wholesaling Inc. Tom Kroll, Cody Hoffine, Brent Daniels. That's
a great podcast. And is Real Estate Investing Mastery on the list?
Real Estate Mastering, it is on the list. So now I'm subscribed to your channel. I'm actually a student of yours too. I've joined the Simple Lease Option program.
Nice.
Probably in June or May of this year. And I'm going to use your strategy to dispo the 3 rentals I'm going to talk about.
Nice. Good. Okay. Thanks for the kind words there. But yeah, by the way, Tom Kroll's podcast and Cody Hoffine's podcast is really, really good, called Wholesaling Inc. You guys should go check that out. I was just texting Tom yesterday, asking him how he was doing. Okay, so you bought some deals in Indianapolis. Okay.
Yeah.
So talk about what happened there. And by the way, I'm sorry if you see me like looking down and typing. I'm typing notes. So I know it looks rude because it looks like I'm not listening, but I apologize. But go ahead. You bought some. How'd you find these deals, or this person that sold these deals in Indianapolis?
Sure. And just to respect everybody's interest here, I'm not going to mention any names, any companies or anything. I'm just going to tell that I subscribed to the channel, and I was learning a lot, consuming a lot of real estate material, learning about how do you run numbers on rental properties. So I felt it like an obligation that, hey, this person is giving me free knowledge. I should invest in rental properties because he's trying to help other people, build real estate investments. So which is why I went into this Turnkey company and then bought rentals. So we started with 3, I had like 3 other partners with me. So we were 4 people, which actually gave the confidence that, hey, let's just invest. These are cheaper properties, like 45,000 a piece. So all my investment is probably going to be around 45,000. And, worst comes worst, it'll be a learning experience. That was what our thought process was when we started. But once we got into it, we were in a hell of a ride because we were promised finished properties at 45,000. We were promised that we would be getting a completely done property. And then all we have to do is collect rental check every single month. So we were in this dreamland. We were thinking, okay, let's buy 50 of these, 100 of these, get that $200 a check. So $200 per property. After all expenses, on 100 properties, you make $20,000. So we can just relax, sit down, each of us, and pay off our expenses, and life is going to be good. Oh boy, we are so wrong.
Okay, so these were, those of you who don't know what turnkey is, a turnkey is a term that people sell properties turnkey, which means it's rehabbed, ready to go, it's rented. Sometimes they'll even offer to manage it for you. Sometimes they'll even guarantee the rents for the first year. There won't be any repairs. So different turnkey providers offer different kinds of rental properties. So Vamsi is in Florida. You have some partners with you. How many partners did you bring on?
I had my brother and 2 other friends. So
did you pay cash for these deals?
Yes.
Okay.
All cash for all these.
And you bought these for about $45,000 each?
Well, the first one was 43, but the next 2 were 45. Okay. So let's just round it up to 45 a piece. And we said, okay, there are 4 of us. We can take it down, learn from this experience.
Okay. And so you bought about 3 of these, right?
We bought 3 of these, and then I got tempted because they were so cheap and we thought we are going to make so much money. So I talked my wife into buying one property.
Oh, no.
And the way we did that is we took money from her 401k account. So she could take up to 50K. So her property was 45. So we took cashed out of her 401k and bought another property. So that's why I said a package of 4 properties.
Okay. So you bought a package of 4.
Right.
And they told you that these properties would be rehabbed,
rent ready, have a tenant in place, and all we had to do was just wait for 3 months for the rehab and everything to be finished and start collecting those rental checks, those mailbox money.
Okay. All right. Well, I think some of you already know what's going to happen next. How long did it take you? Well, what happened next? You just put it in your own words, Vamsi.
So what happened was, like I said, December 17th was when we really paid the money for these properties, and we are hoping to get them rent ready in 90 days.
I'm sorry, was this December 2018?
2017.
2017, okay.
17. And we were promised that it'll be rent ready within 90 days. So in March, we said, hey, let's just drive up. So I drove from here all the way to Columbus, where my brother lives. It's 3 hours from Indianapolis. So we drove to the property, and it was a horror story. 2 of the properties had squatters. One of the property did not have any rehabs done. One of the property was being rehabbed. So I think we sensed that something was wrong. So we went back to the Turnkey company. We actually bought 4 properties ourselves and 1 with my wife. We were able to successfully sell 1 property back to this company. So that's why we are left with 3 properties. We are so lucky that we were able to get rid of that 1 property.
Yeah.
But unfortunately, someone else got screwed because they took the property back and sold it to someone else.
Okay. What kind of neighborhoods were these properties in?
Oh, if you look at the neighborhoods A, B, C, and D, with D being like tough, rough areas, this was in D areas, but they were advertised as C areas, blue collar areas. But they were lower income areas, more crime, more vandalism. So one of our property got vandalized, all sorts of things.
Okay. And what were they renting for? You bought them for about 45. What were they renting for?
They were renting for 700.
700 a month.
Right.
So they were little 2-bedroom, 3-bedroom houses.
That's right. Yeah. 2-bedroom, 3-bedroom. That's it. Not more.
Okay. Renting for 700. So then what did you do? Like a few months later, you're there in Indianapolis, you're looking at these homes and they're not finished. They're in really bad neighborhoods.
Right.
What'd you do?
So what happened was this whole thing just blew apart, and the Turnkey company ran into trouble. They were getting lots of lawsuits filed. So we, on the other hand, we thought, fighting with them, getting a lawsuit filed is not going to get us anything. Let's just take these properties ourselves. Let's rehab that ourselves and put it as a rental. Because if we were to sell them as is at that point, the best offer we got on those properties were like 12,000 or 13,000 from wholesalers, obviously investors, because they had to put in another 20,000. They had to buy it right. Just because we screwed it up and we bought it wrong, we can't expect someone else to screw it up. So the offers they were giving were legitimate offers, and it was kind of painful for us because we know that we can't let them go for 12,000, because that means we're going to take $30,000 hit per property. So we're going to lose 100,000 or 90,000 right away.
Yeah.
So we said, okay, let's just get a property management company involved. So we worked with a property management company. That was another painful experience, because the property management company we worked with told us that they'll manage all the rehab. All they will do is charge us 10% for managing the rehab. And they were very sweet. They were very nice at first, so we believed it and we went ahead with them. Another horror story, 3 to 4 months, they were still not doing any work. They were getting all these bids, high bids, of course. And we paid more money to get them rehab. But in the end, when we saw no progress was being made, we had to fire them and go to another property manager. And this guy did a great job. He's awesome. He's not cheap. his market value, but he's honest and he got the work done, which is what really matters in the end.
So how many months till you finally got him rehabbed and ready to rent?
So we got into this fiasco in March when we knew that it's a pain. And then between March and November, we were struggling between property managers trying to get it done. In November, we got so tired, we fired the property manager and hired another property manager. And it took him just 2 months to get it ready. So by December, all the properties were ready. And by Jan, they were rented out.
So almost a year.
Oh, yeah.
A little over a year, you finally got them rehabbed and rented. About how much did you spend on average in rehab for each property?
Per property, we went up, discounting the first property manager, I think we spent like 8,000 on them for all properties, or 9,000 on them for, I would say 10,000 on 2 properties. It's still very vague what happened with the other property manager, but the next property manager who came in, I know for sure that we spent anywhere from 15 to 18,000 per property. So at this point, we are all in at
18,000 per property. Yeah.
So it looks like we are all in at $63,000 per property. That's where we stand right now.
So you're okay. Geez. And if you were to sell now, are they rented right now?
So that's another horror story. That's another learning experience because of the area.
Yeah.
So it's horror story after horror story, which is why I thought, let me raise my hand and warn other investors getting in, especially people who are in IT who have no understanding of real estate. Stay away from big dreams. Learn first and then get it. So my learning experience from this rental was that they were renting for $700, but these tenants were just beating up those properties real bad, and we had to evict some tenants. In the end, all the money we made from rentals were going back on the rehab of these rentals. So we are making no money on these. So we listed 2 of the properties for sale on the MLS with the realtor. And so the conundrum here is we are in a spot where the area, they're investor-friendly areas. So investors want to lowball us. They want to give us 50,000 or 45,000, which makes sense because they have to buy low and sell high to make a profit. And we can't sell for that low because we are at 60. We want to we don't want to lose much. We want to maybe lose $1,000 per person. So we are ready to sell it with a $5,000 loss per property instead of $30,000 loss, which we would have sold it for initially. So that's the problem. And the homeowners who come in there, they don't have the cash to buy the property. They don't have the money to buy the property with a bank loan because not many people are getting loans. Which is why now that I joined your program, I'm going to use your strategy of lease options. I'm going to take your course, learn all the disposition strategies, and then list them on Craigslist, Facebook, just get that option payment, and then have a lease option tenant.
You might consider for properties that are under $100,000 in the D neighborhoods, I would suggest instead of a lease option, do owner financing.
Okay.
And I can help you with that offline here, but I would suggest looking at owner financing instead. Sure. Typically for the cheaper properties, I don't like doing lease options. I don't want a tenant in there for obvious reasons, as you know. I mean, you don't have very good tenants in those areas, unfortunately.
Right.
But if you can get an owner in the house, sell it with owner financing, and it could be long-term. You could sell it for, I wouldn't charge a ton of interest. I would maybe charge, like if it rents for $700 a month, come up with an interest rate that gives the buyer, after their PITI, principal, interest, taxes, and insurance, they're paying about the same, $750 a month. So maybe that's 5% interest or something fair.
Okay.
But you could sell it on owner financing. Then you can be the bank now instead of the landlord, right? Because even on a lease option, you kind of technically they're responsible for minor maintenance and repairs, which is better than a rental. But again, in my experience on the cheaper low end properties, I think you're going to find a better occupant, a better person in the house if they own it instead, right?
Okay.
And that's just my opinion. Now, if you sell it with owner financing, you don't want to give them a balloon. There's Dodd-Frank issues. You need to make sure you're working with a good licensed loan originator, mortgage broker, a licensed mortgage broker, whatever, that can help you set it up. But that way you'll still get the same cash flow. but less management needed, less because you're not going to be responsible for any repairs or maintenance because you're selling it with owner financing to a buyer. Does that make sense?
Right.
Like you would never call Bank of America to ask them to fix the toilet.
Right.
So you can now be the bank instead, and you're selling it at a fair price, right? You're not charging an exorbitant interest rate. You're just charging 5-6% interest, but whatever that interest rate would work out to be, where they're paying insurance and taxes, you have to make sure that they're getting insurance. You have to verify that, and there's servicing companies that you can hire that can do the collecting and the escrowing of the taxes and the insurance from your buyer. Does that make sense? Right.
I mean, I was going the lease option route is because I will still be on title, it'll still be my property until the person pays off. I was worried that if I go the seller financing route and if they stop making payments, especially because these are rough areas, and they think, hey, you know what, I'm not going to pay. So then I don't want to go through the process of foreclosing it and getting it back and another beat up property. That was one of the reasons why I was worried about seller financing. But let me know if my thought process is wrong.
Well, yeah, you do have to go through a foreclosure. I don't know. I wouldn't say that's any harder than a eviction, and I may be wrong, but a lot of times, 9 times out of 10, you can get these people out by offering a cash for keys program. You know, saying, "Listen, I'll pay you $1,000 to leave," or I can go through a foreclosure or go through an eviction, and you're going to have damaged credit. It's going to follow you forever, and let's just. I'll pay you $1,000 to get your stuff and get out. And 9 times out of 10, a cash for keys program works, right?
Right.
But we can talk about this later offline if you want, Vamsi.
Sure, yeah,
but something to think about. And I'm saying this for everybody out there also as well. Like when you've got the cheaper, lower end properties, think about owner financing instead of a lease option on the cheaper properties. Lease options, I think, most of the time work better for the nicer ones. Maybe in the Midwest, homes priced $100,000 or more. Okay, so how many of these properties do you still have now? You still have 3?
We still have 3. One is rented, but the 2 are fixed up and listed with a realtor.
Listed for sale or for rent?
For sale.
For sale.
Next, we said in that we accept payments, so which we can come back to either lease options or seller financing or any of those strategies.
Okay. What, if you don't mind me asking, these properties that are listed for sale now, what are you asking for?
So right now, because the property the area has turned, and on one property we are asking, I believe we started with 79 and right now it's at 69. We took it down to 69, and the second property, again, we listed it for 79. We dropped it down to 75. We did find buyers, so that's another horror story. We did find a buyer for one of the property. It was listed for 69 and we got a buyer for 65, but the title company screwed it up.
Really?
Yeah, the title company found something on the title which was even prior to the previous owner owning it before us. And they said that hasn't been closed, so we don't want to give you a clean title. So the buyer tried to clean it up. She couldn't do it, so she backed off. But that was a good sale. We could have sold it for 65 and lost a little, or maybe broke even, to be honest.
So is that issue taken care of, or is it still clouding the title?
It's not taken care of, but now what we are trying to do is make sure that we tell the buyers that we'll only close with our title company, because when we tried to file a title claim, that's when this company came back and said, you know what, please don't file a claim. We'll make sure this property sells, because that title company the buyer was using was a different title company who didn't know what they were doing. They just wanted to give a clean title.
So did this claim on the title have anything to do with the previous company that you bought it from?
Not even them. It's before them.
Wow.
Right.
Okay. All right. So let's talk about lessons learned, Vamsi. What would you do differently next time? Like if you were looking, how could you have avoided this?
Sure. So the first thing was I did not know how to run my numbers. When I listened to the podcast, I learned those things, but I didn't implement them. So what I didn't factor in was I did not factor in 10 to 12% for repairs. I did not factor in 8% for vacancy. I did not factor in 10% for property management, which I now do.
Yeah.
And of course, insurance is something I did not factor in for the property, like property insurance. Now I know how to run my numbers. So that anytime one of my friends reaches out to me now that, hey, I see that you own 17 rentals now. I want to buy this rental. I tell them, you know what, slow down. I share them the link to Bigger Pockets, which has a breakdown of exactly how to run
Nice.
your numbers on rental properties.
Yeah.
And I say watch 4 or 5 of these videos. If you make sure that you get that message from 5 videos, you're listening to the same thing over and over again, it'll start registering. And after they run that deal, they come back to me and say, you know what, if I do what you're saying, I'm not able to buy any property. I said, that's the point. Don't buy them.
Oh, that's so good. Because most turnkey providers, now I'm not going to blast turnkey providers because there are really good ones out there. And I should say that there's only a few bad apples. But there are good turnkey providers out there. But you look at their numbers, you really need to look at their numbers with a grain of salt, whatever that means. But like, you need to look at their numbers because 9 times out of 10, there are going to be their numbers are unrealistic. You need to cut them in half or double them or whatever, like, because they don't include property management, they don't include vacancies or maintenance and repairs, future capital expenditures, the 1 or 2 months it's going to take to find a tenant, and then a lot of them don't even count property. If you're using a property manager, every time you find a new tenant, they charge you 1 month's rent as a fee.
Yep.
Right? That's a lot of money.
Right.
And so people don't remember that. So it's important that you know the numbers. So Bigger Pockets, I agree, they have really good resources on Bigger Pockets' website for people that are looking to buy and hold properties that help you, like cash flow calculators and things like that. So you said you have how many properties now?
So right now we have 14 rentals and 3 in Indianapolis. I don't even consider them as rentals because we're not getting any cash flow, but we're getting cash flow on the remaining 14. And all 14 of them are in Columbus, Ohio.
And are they doing well?
They are doing well. My brother is local. And again, we learned a lesson there too. We partnered up with a property manager who were eating us up they were nickel and diming us to death on those repairs.
Yeah.
The tenant turnover was eating up all the cash flow. We are not losing money, but we are not making money. So now because it's local, we saw what's going on, and now we switched to a different property manager. So I would tell any newbies that the biggest asset you can have is not just your asset, but a good property management company. Because if their model is to charge you cheap for property management, but charge you a ton for rehabs and renovations, you can never win. So when we looked at our numbers, the bank, these properties are financed at 70-30. We try not to leverage more than 30% of the purchase price. So the bank has 70% of their money. So they're taking the most money. I'm okay. It should be us, the second one, maybe the property manager, the third. But when we saw the cash flow at the end of the year, it was the bank, the property manager, who had no money invested in the asset, just providing services. They were killing us, and we were the last one. So now we switched that equation now.
Very good. So you have somebody local in Columbus, Ohio that you trust.
My brother, he's my partner. So
yeah, and he helps you manage the property managers.
Exactly. Yep.
What else would you have done differently?
So another thing I would have done differently is I would definitely pay for a mentor or partner up with mentor who has done these transactions. Because at first we just went with a turnkey company. Again, you can go with a turnkey company, but even a better strategy is to partner up with somebody who already knows what the rentals are, or pay a consulting fee to somebody who's an expert, and they can at least tell you, hey, this is a deal. This is not a deal. You need to look at this. Just pay like a fixed $50 or $100 for maybe 5-6 properties. If somebody is even interested, because most people out there, as you know, in the real estate space, they're ready to give knowledge for free. So to be honest, you really don't even have to pay anybody. So when my friends reach out to me, I don't charge them anything. I just tell them that don't buy this property because you're not factoring in these things, factor in, and they don't buy it. So try to reach out to your friends and family first who have investments, and only if they're making money, then get their recommendation.
Nice. And it's easy to find other landlords in that city who have property, isn't it?
Exactly.
And you can call them. Would you buy properties in those kinds of neighborhoods again?
Never. We actually got a great deal. We got a package of 8 properties for $150,000 and similar areas. And one was a 4-plex. They were ready to give it us for free. We still didn't go for it because we didn't want to go through the same nightmare.
Oh man. So what kind of areas are you looking for now?
So right now I stay in the B, C, in those areas. I try to stay closer to B minus areas or C plus areas. So what we are again trying to do is make sure that in our portfolio, we are at maybe 60-40 equation where 60% is in the B areas, or 60 to 70% in the B areas and 30 to 40 in the C areas. But the C areas are only to get that cash flow to make sure we pay off these mortgages and all that stuff. But eventually we'll sell those off and switch up to a better area, because we know now that it's not just cash flow, it's also appreciation which you need. And the lease option strategies you teach is one of the best strategy to own a single family rental, because you don't have to pay for any repairs if you find a tenant buyer.
They're easier to manage. Okay, so give us an example of a Class B or a Class C property in the Midwest, right? So in Ohio or Indiana, what would the price range be of a Class B or Class C?
Sure. So if it's a B area, it's almost above 75 to 80. I would say closer to 100 and above is a B area. Okay. Anything below 100 up to, I would say, 45, 50, between 50 and 100, I would categorize, at least me personally, I would categorize in Columbus and Indiana, 50 to 100 would be a C. Anything above 100 to 150 would be a B. 180, even 180 up to B. Yeah. But anything above 180, I think it'll be a B plus. I would never go into any property, a single family, which is more than 180, because your cash flow doesn't make sense at that point.
Yeah, that's true. All right, so then for what would they rent for? What would a Class C, $50,000 to $100,000 property rent for?
Sure, that would be probably anywhere from 650 to 700. They could go up to 800. It's a stretch, but you could get it if you had a good property manager who can advertise like crazy and then get a better paying tenant. But there's no guarantee. There might be a tenant turnover because they are paying so high. B area, I would say, at least in Columbus, Ohio. I don't know about the entire Midwest, but in Columbus, Ohio, a B class area would be anything which would be, I would say, 900 and above.
Okay, good. All right. So what was the biggest lesson you take away from this, Vamsi?
So the biggest, again, my lessons are not done yet. I'm still learning lessons on every screw up I do. Yeah, so my biggest lesson is just do it, learn it, either partner with somebody. So there's a cost of education. You either pay a mentor or you pay your partner to learn it, or you screw up and then you pay more than what you would have paid these people to learn it.
Yeah. I heard somebody say once, you think education is expensive, try ignorance.
Right. That's an example.
I know I've spent a lot when I've made a lot of mistakes, and I'll talk about some of my bad deals as well on a future podcast. But I went to some very expensive seminars back in 2009 and 10 with some of the properties that I bought that I shouldn't have bought. Okay, cool. So what advice would you give to somebody else listening to this, Vamsi, right now who wants to, buy cash flow rental properties? What are some things you'd say to them?
I would just say that don't be in dreamland like we were when we got started. Just try to understand the facts. Talk to your friends and family who have been investing in real estate, or if you don't have anybody who's done it, join the Facebook groups, join a mentorship program, learn how things are done, understand the pitfalls, and then invest. I know your money is not going to run anywhere. You might be under stress that your property is not appreciating or making you money. But if you invest without having the right knowledge, you won't even see that money again.
Yeah.
So
good. Vamsi, would you do me a favor? As soon as we're done here, would you send me some of the links of the resources on Bigger Pockets that you mentioned that you send to other people? Okay. And I will include them in the mind map. Sure. For people to get. Would you mind doing that?
Definitely, I wouldn't mind at all.
It's good information. And Vamsi, do you have a place people can go to reach you, or just find you on Facebook or Instagram or whatever?
Yeah, right now I just have Facebook. I don't have Instagram. Amigo Vamsi is my ID there in Facebook. They can reach out to me, and again, if they still want to talk about, I'm not going to tell them the name of the company or the turnkey company which screwed us, because, again, you can focus on either the losses or you can just focus on it as a lessons learned, and then just move on.
So which is why you're going to be very successful, Vamsi.
Oh, thank you.
I think you have a bright, awesome real estate investing future ahead of you. Don't quit. Don't give up. That's awesome.
Never give up, because my wife gave up because she lost $25,000 right away. But on the other hand, I said, okay, you take care of our home expenses, I'll take care of our investments, and I'm not going to give up. And which is why we are up to 414 rentals now, and our goal is to get to at least 100 rentals, so we can get enough cash flow, which can pay off our monthly expenses and still have money left, so we can invest more and just keep building that portfolio.
There's a good book I have called Building Wealth One House at a Time.
I heard about that.
It's a really good book. I have it right here on the floor. So Vamsi, cool. Can you send me the links that you talked about from Bigger Pockets? I know they have some really good resources there that are free. They have blog posts, forum posts, calculators, resources. And so if you could send me those links, I will put them in the mind map. And again, guys, if you want that mind map with the notes from this, the lessons learned, even we'll eventually get into the mind map here, into the notes, the transcripts of these podcasts. Text the word BAD to 313131, BAD to 313131, or just go to joemccall.com/bad, and we will forward you the link to get the mind map or the PDF, whatever we have in here, as we go through this. And my assistant, so if anybody watching this live now, you're not going to see the notes until my assistant goes through this video and adds them in here, and I'm going to add some in after we're done here. But Vamsi, I sure appreciate you being on the podcast here, taking the time to talk about your deals gone bad. I want to wish you the best of success, and hope you do well. Let's keep in touch, okay?
Perfect. Thank you so much. And you're doing amazing things in the real estate space. No doubt about that. I first heard your talk in the Wholesaling Inc. Summit in 2018, October.
Oh, yeah.
The first time I heard you, I'm like, hey, I need to learn from him. But then I decided to stick to one path, focus on wholesaling, cash sales, and then start adding other tools to my toolkit, which is what I'm doing right now.
Nice. Appreciate that. Mark Davis says here, always enjoy your stuff. Many thanks. We got a question for you.
Sure.
Real quick from Deb. Did you buy a title policy when you bought the property the first time? And if you did that company have to clean it up?
We did buy a title policy, which is why when we threatened them that we're going to file a title claim, which is when the title company came back to us and said, hey, please don't file a title claim. We'll help you. We'll make sure that these properties are sold.
Yeah, they didn't want to get in trouble with that.
Right.
Jonathan, hey, bad to the bone. Jonathan Rexford, he's my man. In fact, I got him. I'm going to be talking to him next, I think. He's got lots of deals under his belt, and we're going to be talking about one of his bad ones. Chris Chico, my obnoxious best friend. When deals go bad, Joe McCall gets to the bottom of things. Whatever, Chris. Good. We got John here from Tempe, Arizona. What's going on? Sudi, how are you? I just appreciate you guys putting in the comments in here, and it lets me know that you are listening to the show and you like it. All right, Vamsi, thanks again. Appreciate it. Send me that stuff, and I'll put it in the mind map for you guys to get. Text the word BAD to 313131. We will see you all later. Thanks again, Vamsi. Bye-bye.
Thank you, Joe. Bye.